Hi, it's Arjun. We're going to start with an apology for those of you that prefer the written post, that this is going to be our third straight week of doing a video podcast with tariff trade war policies seemingly in super vol mode and the markets making dramatic moves. We do again want to provide our takes. We don't like the hot takes. It's not what we're about. Responding to the emotion today, we're going to try and avoid that. We're going to try and stick with the long takes on what all this means for the long-term energy macro, key themes, CAPEX, M&A, and all such things. And I think a few overarching themes to begin with. And I should say, we are recording this Thursday, April 10th, after the close. So if anything happens Friday before Saturday publication, we will address it in a future video if need be. But a few overarching themes. We don't think this trade war genie can be put back in the bottle. So at least through, as of Thursday, President Trump has pushed out for 90 days the implementation of some of the extra reciprocal tariffs. But the world is evolving. And I think the assumptions that were made over the last 30 years about trade and geopolitics and conventional wisdom around economics, they're evolving in some direction. And we're going to some degree have to see how this plays out. But I think wishing and hoping that we could just call a mulligan in all this and go back to where we were already headed in a different direction. There'd already been talk about deglobalization. We went through Brexit and Trump won, and even the Biden administration and some of the policies there. We're not going back to what we were operating under. And I think all companies, all industries, but certainly the energy sector is going to have to grapple with what that actually means. We have said for energy, we view this tariff trade war as a broad macro event, not energy specific. And we said that last week, and we're going to stick with that view. The debate for energy right now is simply what kind of GDP slowdown do we get? How might that impact energy commodity demand, oil, gas, all the other commodities? And then what is the supply response relative to what certainly currently is weaker pricing and could even weaken from here? That's going to be the energy discussion, but the whole event itself is a macro event, of course. I think OPEC's decision last week to pump for Trump, we don't know that for sure, but the timing sure seems suspect. We saw a follow-up deal where Saudi Arabia is now buying some LNG volumes, all ahead of a visit to the Middle East by our energy secretary and I believe President Trump as well. So whether it was pump for Trump or not, it's made it feel more energy oriented. And I think our view on that is still OPEC had some spare capacity. They're bringing it on at probably an inopportune time, but I'm not sure when is the better time. And let's just get it out of the way. We're going to go through some downturn. It's going to be an accelerant, but it does clear the decks on that overhang in the event we do get some GDP stabilization at some future point in time. So we don't view OPEC as now causing some multi-year down cycle that is energy specific, distinct from the trade war. And therefore, if, or I should say, when global GDP inevitably stabilizes and recovers, that is the time we would expect energy to follow suit. Therefore, it is more like COVID and the great financial crisis than some energy specific type downturn where you worry about a multi-year period. This could be longer lasting, but whenever we get global GDP recovery, we would expect energy to turn with it. So there are about 5 questions or topics I'm going to try and quickly go through here. I mean, the first is, will this be short or long term? And we're going to stick with, we don't see this as the start of a multi-year energy specific downturn a la the 1986 or 2014 crashes. We stand by that view. But we don't really know how long it's going to take to reorder our global economic and geopolitical order. And it is likely to be choppy along the way. That general GDP choppiness has been a basis for us saying super vol, not super cycle when it comes to energy commodities. We did not anticipate this degree of a trade war for sure, but it's certainly going to reinforce those trends. I would differentiate that from saying we're in permanent bear market mode for global GDP either. I'm not so sure that is the case. And there's a lot of bearishness. There's a lot of concern right now. Most Wall Streeters are instinctively free trade. But I will say this, we're going to see what the reaction function is going to be for different countries. And we'll see how long it lasts. But in Europe, in Canada as examples, we'll see about China and India and other countries in Southeast Asia. But do we get, at least within those regions or countries, pro-growth, deregulation kick in. And there's talk of that in Europe. There's been some talk about that in Canada. That in the near term isn't going to offset whatever slowdown we have because of a trade war. But if on the other side you can get more pro-growth deregulation policies in some of these places, that could be a silver lining to think about. And even the talk of Europe starting to rearm and increase defense spending and therefore take on more budget deficits and fiscal spending, that tends to be the kind of thing that, again, we have to get through the near-term noise. We're not trying to say it's not going to happen, but that can be positive for growth on the other side of it. I think that old world of what I think we used to call the G7, Europe, Japan, United States, that world is long gone. There are many, many countries. We got China, we got India, we got a whole bunch of other countries in Southeast Asia, maybe even some countries in Latin America that are all worth watching to see what are their reaction functions. To some degree, they're all impacted by what happens in the US, but they also, in some degrees, to varying degrees, have an ability to figure things out on their own. So I think there's a lot to monitor there across the macro. And this is just not the kind of traditional global GDP synchronous growth or degrowth, slowdowns and noise we've had in the past as we're, again, as the world is reordering some of these alliances and trading norms and so forth. I think the second area you want to talk about is with shale oil specifically, and drill, baby, drill. We've not thought that companies were going to crank up CAPEX had oil stayed at $70 a barrel. And I think the question is, can costs reset lower? Let's just say oil's 50 as an example. Could we have the kind of reaction like we did in 2014, 2015? And we're going to say we don't think so. And it bears some explaining. In 2014, when oil was 100, the consensus view, which we shared, was that if oil fell to 70, it would be devastating for shale economics. They couldn't survive it, and we'd very quickly have negative production. Oil did fall in 2014, at the end of 2014 and 2015. It fell all the way to 50, and it was initially quite negative for the rig count and shale supply and so forth. But the industry quickly reset and dramatically reduced costs. And of course, we had a huge wave of productivity gains in shale, drilling longer laterals, doing more frac stages per foot drilled, all those kind of things, understanding the reservoirs better. And industry got to where it believed it could generate good returns at $50 oil. And in an environment where oil was around 50 to 60, we had pretty dramatic positive shale oil supply growth in 2017, 18, and 19 and until COVID. And so the question is, can that repeat? So right now, no one believes that a $50 oil would be a good thing for shale drilling, but we were all wrong 10 years ago. And I'd say, I do think this time we are 10 years progressed. Shale is significantly more mature for some swath of industry, maybe not the largest and leading companies, but for many others. We were starting to wonder, is shale oil growth becoming more price dependent? That yes, you can grind out some growth at $70 a barrel, but you're really going to start needing perhaps 75, maybe 80, maybe even 85 or 90 to really motivate what we currently call tier 2 and tier 3 drilling. That's what we were thinking before this trade war. And there's nothing about the trade war, increases in steel costs and so forth, that makes us think $50 oil would be anything other than leading to production decline. So we're 10 years progressed from 2014. And I think if the administration or anyone else is counting on that kind of reaction function, I think we would express some caution towards that. And we'll have to admit, we were wrong 10 years ago. Prices fell, costs fell, and shale activity accelerated. But we are significantly more mature. We would expect production declines if oil went to 50. I think the third topic area has been the power and AI trade. I think the justified optimism that we were starting to see a very big positive inflection, not just in US power demand, but in Europe and other parts of the world, a global thing. And that's due to economic growth. It's due to an aging grid and infrastructure. There has been a growing amount of intermittent resources. To what degree could battery and storage and these kind of things help stabilize the grid? To what degree were we going to need natural gas or nuclear? All the kind of, I'm going to call it power supply demand type questions. And all of this was going to be turbocharged by the digitization trend and artificial intelligence. And I think those broad themes still hold. Clearly, if you're going to have some amount of economic weakness, power is not going to be immune from that as a general point. But I think a lot of the challenge is about the need to invest, the need to motivate investment. through companies believing they can get sufficiently attractive returns. We're still going to need all that. Whether it gets pushed a little bit to the right or the slope of the line's a little slower, there definitely are people who are better experts on power than myself. But I would say that broader theme of electrification and I'm going to call it the power AI trade, I think is still going to be here. I think what we don't know, and certainly we don't specifically know, is to what degree will tariffs impact how you might weight the different options you have. It's going to vary greatly by area. So if China is kind of the dominant provider of solar panels, we know they have a huge position. We know they're able, will tariffs cause that cost position to change and to either favor other regions, or how does that play into natural gas versus solar? There are all those kind of questions that weren't being analyzed. We'll see how it plays out. But I think, that type of change we think is a question we have more so than is the power trade, dead forever. Absolutely not in our view. There's going to be a heck of a lot of need for new power generation. I think on the new energies front, we've been generally pretty skeptical of the immature, unprofitable new energies areas. These are not solar or things that have become more established, but green hydrogen. There's a long list of them that various administrations have promoted, and I think we remain skeptical. I'm not sure tariffs have anything to do with making them even less economic than they already were. I think the only caveat to that would be, and it bears watching, is how does the geopolitical element play into some countries wanting to really crack the code on some new stuff? And so if you're being threatened with tariffs and trade wars, and you don't know 5 or 10 or 20 years from now exactly who's going to be your friend or foe, one of the things you're going to want to do as a country is to control your own energy. That's always, to me, been the best case for a whole swath of, quote, new energies, including solar and batteries, including, frankly, wind. And nuclear fits this bill. Will the trade war create a new impetus on other new energies? We'll see. It's a long-term kind of thing, but I do wonder about that. The fourth area would be M&A activity, and what does all this mean? And we're 1 week into this thing. It's almost certainly true that there'll be a freezing of activity in the very short term as bid-ask spreads remain wide, and both companies, whether they're buyers or sellers or anything in between, try and sort through what is the environment going to look like. Again, it's very early in the process, but it is something that is going to be worth continuing to evaluate. We know whether we're totally free traders or totally protectionist or anything in between, the world will always need future low-cost energy sources. We've got the lucky 1 billion, we need energy. Got the other 7 billion people on Earth, they're going to want and need more energy. And so we're always trying to figure out what is going to be the future low-cost resource. There's no one answer to that. It's going to vary by region, by type, by company, in terms of what different people are good at. That will always be the case. Are there companies that are going to be better or worse at navigating this type of very uncertain macro market? Absolutely. Are there going to be some companies that, under the old order that we've been operating under, were fine alone, but now might want to think about merging as equals or getting? For sure. We need some more time to pass, almost certainly, but I think companies are going to be needing to think through what is going to make sense, what are the opportunities that are going to arise. I think the fifth and final area you want to talk about is just sort of, how do you think about knowing when you are at the trough of these things? And again, if you're 1 week into it, usually these kind of dramatic moves do not end so quickly. And again, we're going to start with, we don't think you can put the trade war genie back in the bottle. We've always turned to the return on capital cycles. It's kind of an interesting time for energy. And we're going to write about this 2 weeks ago, that, after a deep trough and an extended downturn, we had a normal return on capital year in 2021, 2 kind of peak or really good years in 22 and 23, and 24 was again a normal year. And could we avoid what we were going to call a mini cycle going back to trough? There's no question that the trade war significantly raises the risk of seeing trough conditions. Now, we didn't have the major ramping CAPEX that you would normally look to as a sign for when it's cut, you start getting to trough. Balance sheets are healthier. So it's going to be a different kind of, quote, trough environment than what we've had in the past. But you'll always look to when are returns on capital below normal. You're going to look to when does it seem like the market is discounting unsustainably conservative conditions about the type of prices and returns you need to inevitably stimulate supply for what we know is long-term needed oil demand. How will we look at if CAPEX is cut, the timing of supply declines in shale and other areas? And then how does the EPS revision cycle play out? None of these things are perfect. It is as much art as it is science, but it is that framework of looking at profitability cycles that is what we turn to, especially during these trying times. And frankly, we try and use it to not get too enthusiastic when you're way above normal as well. Looks like we're going to be headed towards a weaker period of profitability, at least for some period of time here. And I think looking at CROCI, return on capital, free cash generation, and how these trends play out is going to be one of our kind of the core things that we look at to try and determine, are we at trough and what are we discounting at this moment in time? So I will still end this video on a personal note, and I want to harken back to Goldman Sachs's former CEO, Lloyd Blankfein, and what it was like to work as part of the firm during the great financial crisis. And we used to have, I think they were monthly partner meetings during that GFC. I was an 06 partner, so the GFC was just 2 years after that. And it really, Lloyd's speech to all of us always stood out to me. And I'm going to paraphrase here, but it was always, this is Lloyd talking, I'm always getting asked, what inning are we in? Are we early, late? When are we going to be through the worst of this downturn? And when can we look forward to better times? And his comment to all of us was, stop wishing your lives away. Stop hoping and praying for some better time to just suddenly materialize. It is your job to execute today on behalf of our clients. And make no mistake, this is 08. There's none of the touchy-feely stuff that we have in the world today. So I'm not saying we were trying to get some humanitarian message about our mental health and to feel better. It was about do your job, and if you do your job, Goldman's going to not only survive but thrive through this downturn. And it was a fantastic message. Do not wish your life away. Live for today and try and do the best job you can. In my case, analyzing energy stocks. In other people's cases, trading or investment banking or sales or research or whatever the case would be. And as I mentioned last week, it was actually those most dramatic times during the financial crisis that still stand out to me most. It was a trying and tragic time, and we're not trying to be dismissive of the suffering that some people went through during that era. But from a career standpoint, these were the most notable days. So we are not going to wish our life away. We're not going to just wish for this trade war to magically go so we can just have a nice, smooth bull market. There's no such thing. There's no such thing. And so just wanted to remember Lloyd Blankfein, who I thought was a tremendous leader for Goldman Sachs in that era. And I'm grateful to work at the firm during the GFC. Thank you.